Hi everybody, this is Sean. I hope this video finds you well. Laura, Shannon, and I wanted to send out a quick video to you to talk a little bit about the markets. As you can see, this is titled, There's some choppy waters for sailing right now. And to be fair, that's a euphemism for things look a little rough out there. So let's take a look at that right now. This chart, which was created a little earlier today, shows year-to-date how things are going. So as of this afternoon, year-to-date, the market was down about 23.3%. Now that's not the low point for the year. Actually, we hit the low point back on June 16th. As you can see, though, we're very close to what that level was. So that's called a retest of a bottom. And we'll see how the day ends up. But that's kind of where we are year-to-date. So we started the year, we went down, we had a noticeable recovery, as you can kind of see in here, and then we've kind of given it back. What is causing that kind of turmoil, that kind of up and down and up and down? Because you can see it's not straight down, it's not definitely straight up. So what's causing that? It's a related issues. The related issues are inflation and rising interest rates. So inflation started to really spread out through the economy, and the way that the Federal Reserve responds to that to try to control it is to raise interest rates. So that's kind of what's going on, and that's why they're related. Now, I know the question you'd love for me to answer is, Sean, when's this going to stop? You know, when are we going to finally stop going down and have a noticeable recovery? And I'm going to be very clear with you, don't know. None of us do. I know what will kind of cause that, and that is when the market feels like the interest rates are going to kind of level off. When the Fed's going to stop aggressively raising the interest rate because that means they feel like inflation's under control. That's when the markets will finally noticeably recover. We do have something in our favor this year, and that is we are in a midterm election year. Historically, midterm election years tend to turn around after the election in the markets. So what I mean by that, there's several midterm election years where the markets have been really unsteady and choppy. As soon as the election's over, then the market can have a noticeable recovery starting about mid-November into the end of December. And the interesting thing about that, when you look at the history of it, it doesn't matter which side wins. That happens under Republicans, it happens under Democrats. The issue is the market just wants to know who won. And once that's determined, we often have a noticeable recovery. Now, is that going to happen this year? I can't tell you for sure if it is, but it is one thing that we have going for us on this. The other thing on, like I said, when is interest rates going to stop rising? It's when inflation's under control. And when's that going to happen? Well, let's look at a couple things. First of all, inflation victory. You know, when do we get to declare victory on inflation? Let's talk about what that isn't. That does not mean that prices have gone back to 2020 levels, because that's just not going to happen. That's not the way inflation works. Inflation doesn't tend to keep resetting backwards. It kind of sets new highs and new ceilings. Doesn't mean nothing. It doesn't mean no prices will go back, but overall, we're not going to see the average level of 2020 prices. Well, if that's true, what is inflation victory? Well, what inflation victory will mean is that there's a noticeable slowing of the pace of increase of inflation. Most economists agree a steady low level of inflation is actually necessary for a good and growing economy. So zero isn't the goal on inflation. A negative number is definitely not the goal. That's called deflation, which is scary for its own reasons. But the rates we have now are much too high, and that's what they're trying to control. But we know that we'll have victory once there's a noticeable slowing. What's interesting about that is there's certain things already starting to kind of point that direction. So as you can see here, this is the price of oil. We hit the high on oil back on around March the 8th, where it got north of $123. And you can see that here. Right now, as of today on the market at about 1:20 p.m., oil was at $86 and some change. So that's a big difference. That's a 30% decrease in price. And oil is really important for inflation for several reasons. The most noticeable way is oil turns into gas, and you know what you pay at the pump. And that's true. That's part of a consumer's inflation. But consumers also get hit by oil prices in other ways. First is everything that you buy has to be transported, and it gets transported using some form normally of fossil fuel oil. So no matter what you're buying, the price of that can be influenced by what did it cost to move it around. The other thing is oil is used in a lot of manufacturing. Petroleum is used in a lot of manufacturing of chemicals and plastics. Uh, so that is a raw material cost that goes into manufacturing. As it comes down, the price of manufacturing goes down. So this is a really good sign for us that things are starting to moderate a bit. Here's some other things that are anecdotal. Costco management just released a statement. I believe this came out yesterday when they were discussing their earnings. And they said their container rates have gone down. Now, containers referring to like those big metal shipping containers that they have to move things on either trains or ships with. The rates to get those have come down, which is part of the cost that they have to bake into their prices in their stores. So that's good. Container shortages have improved. So earlier in the year and last year, it was really hard for retailers to get a hold of containers, and that's what made their prices go up. Now that the supply has changed, classic supply and demand, more supply means that I don't think the demand has gone down, but the supply has gotten better, so that's making the price come down. And Costco also noted that port delays have improved. They're referring to when manufacturers overseas have to ship things that has to come into large ports in the U.S. For a while, we were having big problems there with ships staying offshore for a long period of time. That's gotten better. Lastly, Costco does manufacture things. They make some of their own products. They said their raw material prices have come down. So all together, they said we're seeing things starting to go in the right direction, and that's what we talked about. They're not totally fixed, but they're now heading in the right direction. Here's another one, Manheim Market Report. This is an index of used car prices. And in a report they just released a couple days ago, they said the wholesale used vehicle price, and that refers to the price that people who sell the used cars have to pay for those cars. The wholesale used car prices went down about 2.3% in the first 2 weeks of September. So just in 15 days, they saw a noticeable decrease. And then when they measure all the way back to January 1, they're showing that used car prices are down an average about 13%. So here we see oil going down, which is a major factor in a lot of inflation. Costco, which is really close to consumer, saying a lot of their costs are going down. And then used car prices are starting to head down. So there are indications that what is happening is starting to impact inflation in a positive manner. Now, Reliant has two guiding philosophies when we build portfolios, and we've talked about this with some of you before, but I'm going to review it real quick. We have two basic guiding philosophies when we build portfolios. Philosophy number one is avoid big mistakes. Because it's interesting, the way the math works, most clients don't need us to do extraordinary returns to achieve their goals. We don't have to do anything amazing. But most of their goals may not survive a big mistake if it's made. So a lot of what we do is try to avoid the big mistakes. The second thing we do is try to make sure that the portfolio is fit to the plan and the situation. And this one's a little harder to wrap your minds around, but it is very interesting. You can have a collection of all good investments. When you look at each investment on an individual basis, you can say that's a good investment, and that's a good investment, and that's a good investment. But when you own them all together, it's possible but that they are totally inappropriate for one particular situation or not. So not only do we need to avoid big mistakes and try to get good investments, we need to make sure that the portfolio actually fits the plan. So let's look at those two philosophies in a little more depth for us. So what this chart is showing a 20-year annualized return of different types of investments. So down here you can see the types of investments there are. REITs, that is commercial real estate. Over the last 20 years, that has done the best, as you can see. But then there's other investment types. This is emerging market equity, so small country stocks. S&P 500, which is marked here, those are large U.S. stocks. Here are small U.S. stocks, high yield bonds. This is international stocks. Here are just bonds, corporate and treasury bonds combined. Here's homes. Now, the interesting thing about this chart, though, is the second thing that's marked. The average investor over the same time frame. So when the folks that put this together, Dowbar, do research on this, and this chart was actually put together by JP Morgan. They took Dowbar data and made it pretty, basically. What they find is the average investor over the last 20 years has averaged about 3.6%. What's interesting about that is almost everything the investor's putting in their portfolio, bonds, international stocks, US stocks, real estate, almost everything they're putting in the portfolio has done better than the investor themselves has done. And that's really curious if you start thinking about it. And why is that? It has to do actually not with any technicals of the investments themselves or anything along those lines. It has to do with behavioral finance issues. So what do I mean by that? It's that difference between how the investor has done and how the investment is done is driven by two primary emotions, greed and fear. And as advisors and people trying to walk alongside clients, we have to fight these emotions. And that's a big part of our job, is that kind of psychological help. Now, what's interesting right now, we don't have to worry too much about greed. There aren't very many people being greedy right now. Greed rears its head at times like when a cryptocurrency goes up 25% in a month. And then people reach out and say, hey, maybe I should buy some of that. Or the meme stock craze that went through a couple of years ago, if you'll remember, and buying stocks of companies that didn't make sense. They didn't have earnings, and yet they were doing 10, 20, 30% rates of return by the day. That's when greed rears its head. That is not what we're facing right now. We're facing fear. And what fear looks like in a portfolio is what follows. Fear occurs in a portfolio when someone sells after losses has occurred, but they don't reinvest until those investments have already recovered. So what does that look like? Let's say this is a portfolio, and this is what the value of the portfolios look like over time. So it started here, got some good returns, but then we hit a year like 2020 and it starts to drop. And as a matter of fact, it dropped just below where it started. And that point is normally a big psychological trigger for folks. There's some point that you have in your head as the start point. There's a technical term for that called anchoring. You have anchored at some point in the past. Once the portfolio drops below that anchor point, that's a trigger. And your brain says, hey, we got to get safe. We got to protect ourselves. And the way clients think to do this, well, maybe we should sell at that point. So right after it might breach that point, you think, okay, selling here is a good idea. That's what we're going to do. Okay. Then the market continues to fall. So they feel pretty good about that decision. They're like, yep, I sold here. Look at all this money I saved myself. I would have kept going down, down, down. But no, instead I kind of locked it in here. The issue with that is anytime you sell, that's actually a two-part decision. You have to get both parts right for this to work out and to have actually helped yourself. Part one is when to sell. You have to sell before we've actually hit the bottom. And Laura and I have noticed all the way back to 2000. We can name clients all the way back to 2000 who have sold assets almost perfectly at market bottom. It's almost uncanny. Within a week, in every major sell-off, within a week of the bottom, we have had at least one or two clients, that's finally when they decide to sell. So their first decision when to sell is off. But let's say you did like this, and you sold and the market continued to go down, so you feel like it's a pretty good idea. The second decision point is, but you have to get back in. And this is what the market does. The market will recover, as I've already admitted. I have no idea when, but it will. And the issue is, for this to have worked out, you have to buy back in at a lower point than you sold. So that's represented by this green dotted line. You got to get back in lower than you got out for this to have actually helped you. The issue is this: you sold because of fear. And that means you have to rebuy at a lower point when fear will be even higher. The likelihood of that happening is almost nil. Because this was not a rational decision here, this was an emotional one. And you're not going to get more rational as the prices keep dropping. So this idea that, yeah, I can sell at a good time when the market will continue to drop, and then I'm going to buy back in lower than that green line, it doesn't happen. What normally happens is somebody sells, and then they rebuy more up in here, which means they cost themselves money, and they'd have been better off just staying put where they are. Okay? This is one of the big mistakes that makes that data that we already looked at on why investors underperform the investments themselves. Because the investments just continue chugging along and doing what they're going to do. Investors get in and monkey with it sometimes at the wrong times, and that causes problems. Now, the second thing that we try to do in portfolios, like I said, is fit it to the plan. Now, this you have heard many, many times from us. If you've been with us for any length of time, you'll have heard this. But sometimes it's nice to have a soothing, comforting voice in times of trouble to remind you of this. Unfortunately for you, Laura doesn't like to make videos, so her soothing, comforting voice isn't the one you hear. You have to listen to me. But I'll try to do the best I can. First of all, if you're actively withdrawing money from accounts, there's two major things that we'd like to remind you of. One is that analysis has already been done to determine what the withdrawal rate should be, and that analysis was done assuming bad markets like we're in right now, okay? We do not do Goldilocks analysis where we assume everything has to be just right for it to work. We have to assume if it's bad, what are safe withdrawal rates? So your withdrawal rates were determined already assuming bad markets. Second thing we'd remind you of, if you have liquidity reserves or buffers, they exist for this exact reason that we're in right now. Those reserves and buffers give us a source of money that hasn't fallen at all or nearly as much as the market itself, so that we can continue to provide you cash flow without having to touch the market itself, and we can try to wait for the recovery before we do. These two things, this A and B, are part of what you've heard us refer to as the reliant harvesting strategy. There's actually 6 parts to that harvesting strategy, and these are 2 of them. And using the agricultural analogy that we do, this is where we determine your reaping pace. At what pace should you withdraw? And this is what we refer to as the silos. When the harvest isn't good, we need to have grain stored up for the winter, so to speak. And that's what these reserves and buffers are doing for us. A couple other things. At today's market levels, these will probably provide pretty attractive investment points when we look backwards a year or 2 from now. One big surprise Laura and I had in 2020 is we had quite a number of clients in the downs of 2020 actively reach out to us. Laura and I did not make these suggestions. Actively reach out to us and ask, hey, is now a good time to put in money? Because I think it is. And for all those people that did that, it proved to be an excellent time to put it in. Now, they didn't have to wait a year or 2 for that proof to come out because of the speed of the recovery in 2020. They only had to wait a matter of weeks or months before that made sense. I don't think this one's going to work that way. I think this is going to take a little longer because we have a systemic issue of inflation. It'll take a little longer to work its way through. But money put in today, I feel really confident when we look back after 12 to 24 months, you'll not be sorry that that happened. For the people that it works for, Roth conversions now work really well in this environment. And we've been actively doing those. Several of you know that we've done this. We did a whole batch of them back in around May, June timeframe, and then we started doing them again as the market started to fall again into August and September. The beauty of a Roth conversion when things are down is Roth conversions do trigger taxes. However, when things are down, they trigger less taxes to move the same number of shares over to the Roth. And then when we do have the recovery that's coming in some time frame, the recovery all happens in an environment that's completely tax-free inside of the Roth. So it's a great time to do those conversions when things are down. Okay. So we'd remind you, if you're pulling money out, there's plans in place to deal with down markets for that. Now's will probably prove not to be a bad time to have put more money to work in the market, and then Roth conversions work really well now too. I hope that helped answer some questions that you have, to let you see there's some method to the madness, and that really your biggest foe is not necessarily fluctuating markets, because that's going to happen. You can't get away from fluctuating markets if you stay invested for any amount of time. It's those emotions that come with it. Okay? It's not the environment, it's the reaction to the environment is where the real danger is. So hopefully you can kind of see some of the logic behind that. If you have any questions, feel free to reach out to us. Here's our contact information. I'm glad you were able to spend a little time with me. We look forward to talking to you soon. Have a good day.